Hello, and welcome to the WPP Media Intelligence Podcast. I am Kate Scott-Dawkins. I am joined by Jeff Foster and Nidhi Shah today. And joining us, we have Aisha Khan, also from WPP Media, helping us to break down all the commerce news that was released this week. We had earnings from a bunch of retail media players. So we're going to get into that as well. But first, just a general, how's everyone doing? Recording on Thursday this week, which is different and exciting, but that doesn't mean we had any fewer earnings to get through. How's everyone doing this week?
Yeah, doing well. It's been another busy week and we're only at Thursday.
Yeah, pretty much. I can't believe how fast the days are going during the week.
Yeah, I don't feel like I spent as much time yesterday as I would have liked with some family medical things. Good news is no one needs surgery, so that's all excellent. But I am going to have to play some catch up, I feel like, over the weekend of just really digesting what everyone said this week. We are going to chat through a couple of the largest global media owners, Fox and Disney, in our top 25. And then we have a slew, as I mentioned, of commerce players that we're going to talk about as well and get into those especially. And we'll have Aisha on hand to talk through from a practitioner's point of view and dealing with clients every day in the space, what we should be thinking about and reading between the lines when we talk about earnings from those players. Should we start with Fox, Disney, Warner Brothers Discovery, and then we'll get into commerce as well?
Yeah, that sounds like a good plan. So Disney went yesterday on their earnings, and I guess that could be best summed up as a shock and awe flurry of announcements that maybe masked the earnings, but, a little bit debate on that. But I think it's interesting to start off with some of the big announcements that came out of earnings or the prior to earnings on the night before. The big one, of course, being the NFL-ESPN deal is official. I think we talked about that a couple weeks ago on the podcast. A couple of very interesting things that, at least for me, I found that they valued ESPN at $25 to $30 billion. So I think it's, puts that in looking at the market caps, that puts it about the same market cap of the value of Fox and about 3 times as much as what Paramount was just sold for, just to play a little fun game. So I think it may show you where the market is valuing sports and sports rights. And I think it was also pretty an interesting detail that the NFL will get a dividend as part of their equity from ESPN. So I think, it's a very interesting deal, but it raises the questions. Do you think we are going to see a spinoff down the road of ESPN? How does the NFL, get out of this investment and get the cash out of it? Or is that, are they playing the long-term game? Like, what do you think here?
That's interesting. I mean, I was listening to the call this morning, again, playing catch up. And there was an analyst question about, where does the value come from? Was giving up a 10% stake in ESPN, and the management position was that it was going to be accretive from the first year after the deal, and so they weren't terribly worried about that. I did see Rich Greenfield on Bloomberg talking about how I think he thought a spinoff was coming. So I think that's a pretty popular view on everything that they're setting up to happen here.
Yeah, that's what it sure seems like. And of course, it raises a whole bunch of other questions if ESPN and the NFL are, disinvolved together on a business standpoint. What does that mean for the other media partners? So I think that's going to be an interesting question down the road too.
That was an analyst question on the Fox call, right? What does the Disney deal mean? And again, what they're projecting to investors was, we have a great relationship with the NFL and everything's fine. But I think, how do you read behind the scenes on that question?
I mean, I think it's an interesting one. I mean, you'd have to be a little concerned if you're another media partner that's not ESPN or Disney, that is the NFL going to give Disney and ESPN some of the better games, some of the higher profile teams, some of the better matchups? It's going to be interesting to see, because they obviously have a vested interest in doing that, and then keeping all their other partners happy. So, I don't know. It's, I think we're definitely going to be in different times ahead for the NFL as we were coming up on all the renewals, and after the end of the, the 2029 season?
Yeah. Well, let's use that we haven't gotten to the advertising numbers for Disney. Let's do that.
Sure, yeah. So Disney, when you're looking at on their linear networks side, the U.S. domestic advertising sales were down due to lower average viewership and rates, so probably not a huge surprise there. Linear networks advertising fell, was it 25%? but of course that was tough comps. And on the domestic network side, so that's ABC Network and locals, they were down by 10%.
Yeah.
Domestic sports advertising here in the U.S. was up 3%. So that, kind of what we've been sort of seeing more or less, I guess, would be the best way to describe it.
Down double digits versus, Meta, Google, Amazon, Reddit up double digits.
Yeah, definitely. Definitely a compare and contrast. Yeah.
Fox actually, advertising wise, looked a lot better. I mean, it's different sort of properties, but I think they're still doing well off the Fox News and cable piece of business that others are really struggling with.
Absolutely. So yeah, Fox News was definitely one of the big powerhouses behind that with higher viewership numbers. And then the few other interesting tidbits, they did disclose that political advertising was well over $400 million for the fiscal year 2025. So that ended at the end of June.
Yeah.
So obviously with the big election cycle. And I think the other interesting ones, a lot of commentary on Tubi. So Tubi having revenue of over $1.1 billion in fiscal year 2025. And Tubi makes up more than 25% of all of advertising revenue in the second quarter.
Wow.
So it's just interesting definitely seeing a high volume growth there on the Tubi side. So there was lots of talk around that.
We love those data points because normally they just give us, revenue up 25% in the quarter, up 30% in the quarter. And so actually getting a number like, over 1.1 actually went into our model and made the adjustments. We're going back all the way to, the 2020 sort of numbers and making sure that they are fit into those few numbers that we do get every once in a while. So we do love that.
Yeah, definitely good to get some clarity on that.
But yeah, the first year then for fiscal year anyway, that they were up over $1 billion. And for calendar year 2 by our estimates, we'll obviously be over $1 billion this year in calendar 25.
Yeah, and that aligns well with the commentary we're hearing out of the upfronts, just seeing most of the big volume increases on the Tubi side.
Yep. Should we do Warner too? And then we can head over to commerce. I also would be actually interested to get Aisha's point of view on the conversations around using commerce data to buy on linear TV or streaming TV in the US too. But let's do Warner Brothers quickly. Total advertising down 10% on a constant currency basis. Streaming revenue was up 17%, but it's and they said this as well, not enough to offset linear network advertising decline. That was 13%. And they had, difficult comps given there were the absence of the NCAA March Madness Final Four and championship in the quarter this year. So that impacted growth by 2%. So even if you're, adjusting for that, it's still a double-digit decline. Streaming still only makes up 13% of total ad revenue for the company. It's up from 10% last year. It was less than 5% in 2023, but really not enough to offset the declines that are coming from the vast majority of advertising revenue at Warner Brothers Discovery.
Yeah, and I think they mentioned that I think streaming did eke out a little bit of a profit this quarter versus a loss last year.
Yes, yeah. No, it's definitely looking more profitable. Yeah. Subscribers are still up slightly.
And they did mention crackdown on password sharing as well, so...
Worked for Netflix.
Exactly. So you can kind of see the playbook unfolding, and it'll probably only be a matter of quarters until they stop disclosing subscriber numbers as well.
Yeah. Yeah, because Disney mentioned that as well, didn't they?
Correct. Yeah, we only have a couple more quarters of Disney disclosing subscriber information on their streaming side.
You get one good piece of actual hard data, and then you lose it on 4 other places. I mean,
exactly.
Studios did well for Warner Brothers Discovery. I think that was a big piece of what helped the entire company up 54% year over year on a constant currency basis. They had the Minecraft movie Sinners and Final Destination Bloodlines last quarter, which helped. But gaming revenue, no new release this year, was down 14%. I did find it interesting. They had a few points on the outlook. Warner Brothers Discovery said the U.S. advertising market environment continues to remain steady with limited, if any, ankle impact from macro concerns, which is, I think, what we said, especially their advertisers are going to be the larger brands that are mitigating tariff impacts as best they can. So that makes sense with our forecast for the year. They did, though, say heading into the back half, it gets a little bit tricky. We expect global linear networks' global advertising revenues in the third quarter did decline at a higher rate than the second quarter, given the lighter sports schedule, the comparison with last year's Summer Olympics, and the benefit to CNN in the prior year from U.S. election coverage. And then they also mentioned, of course, they're not going to have the NBA in Q4.
Right. Yeah, they kind of have a perfect storm for really tough comps.
Yeah, it's going to be a tough back half of the year. All right, commerce. Let's get into it. What do we got, Nidhi?
Yeah, so I think it's been really interesting times for commerce, really. We entered the beginning of the year, there were lots of concerns about, global retail sales growth, like slowing down, questions about e-commerce, cross-border activity, the lot. And now we're into Q2 results and we're seeing some of that unravel in terms of positive revenue growth, positive GMV growth, and, consumer demand still being quite healthy for some of the travel networks and retail media, obviously growing segment part of our commerce category, and as well as last mile delivery services. So quite healthy growth I'm seeing across the board. And I think what's interesting as well, that growth is just not limited to the US-based players like Amazon and DoorDash. This week, we had Mercado Libre report about 59% constant currency growth in Q2 for its advertising revenue. Zalando reporting about 45% growth in advertising revenue for the first half of this year. And I think that kind of concurs with our view of what we've been saying in this year, next year, right? US, China will dominate the kind of commerce revenue, particularly retail media ad revenue. But that kind of growth also coming from other markets, expected to kind of represent about 28% by 2030. So really interesting.
Aisha, does that match with what you're hearing from partners? Are they pretty rosy on what they're seeing this year? Are they touting sort of investments into new formats and products off the back of this growth? What are you hearing?
I think this is very indicative of what our clients are seeing. I think overall basket sizes we are seeing are down, but the unit trips are stable. I do think there is an element of the impact of tariffs. And so there's almost like this tug of war of who pays for the tariff. Is it how much is being passed to the consumer? How much is the retailer eating in cost versus the manufacturer? And so it'll be interesting to see. I think there's different strategies playing out by retailer and by manufacturer, but the overall, I think, trends are that the retailers right now are being quite aggressive on price. Like Mercado Libre is a great example. They had incredible top line growth, but a lot of it came on the back of a lot of discounting and free shipping that they were offering. And so I think retailers are willing to play, at least in the short term, a little bit of those discounting games, putting a little bit of pressure on their own margin in order to maintain growth and their subscriber base and their client base. So it'll be really interesting to see how that plays out over the next couple of quarters. But overall, from a client perspective or endemic perspective, we are seeing that retail media and retailers that are winning are part of this closed loop ecosystem. So to your point on using retail data to buy linear TV, Walmart comes to mind. Amazon's got their entire ecosystem. I think we see a correlation between the ability to see success in retail correlated with success in advertising. So I think more and more of these retailers are going to double down and expect clients, and clients are actually seeing good results as well. It's not just a money grab and a tax, as we hear a lot of times in this space. We are actually seeing fantastic results when we are tying retail data to upper funnel results, because you have that immediate measurement, and you can also do lower funnel campaigns, retargeting campaigns against those audiences that are highly engaging. So I think overall it's a win-win for the consumers and brands and retailers, but there'll be a little bit of short-term pain, particularly from tariffs.
Yeah, and you mentioned Amazon, Walmart obviously have their own media aspects. Roku was highlighting their tie-ins with sort of interactive ads and relationships with Amazon in particular about being able to add to cart or get more information from within the ad units. I think we'll see more of that. And Nidhi, you called out Coupang this week in that space as well.
Yeah, it was really interesting, actually. They've launched something called a sports pass. So Coupang also have, aside from their e-commerce business, Coupang Play, which is a kind of entertainment video space business, and including international sports such as NBA and Formula One and Premier League. So really, we're seeing that kind of not just e-commerce being focused on e-commerce, but that kind of entertainment side as well, converging into these kind of properties.
So how are clients ranking these things, right? Like, okay, so great, you have sports, you have your own media, which means maybe the integrations are better, or I'm getting a better deal on something, versus I can get reporting faster, or the performance is this little bit better. How do clients think about that when they're evaluating partners in the space?
I think right now there's, due to just the scale and the overwhelm that partners are seeing and demand from retailers to spend, I think more clients are taking a rather rigorous approach and really comparing. So despite the fact that some of these entertainment platforms may be tied to retail, I think they're doing a fairly good job of taking a step back and saying, well, let's really compare this to true apples to apples comparison versus, well, just because they're tied to a retail doesn't mean, let's look at the CPMs. Is there a CPM premium associated with this? Is this actually going to drive my KPIs and brand? And so I think they're ranking, they're still seeing retail as conversion. So it's got to drive sales first. I think they're open-minded in having those conversations of when these retailers have, again, these full funnel capabilities or entertainment capabilities, but they're still skeptical in terms of, again, the efficiency maybe is the right word. So the effectiveness is there, but I think the costs are really high. I think these retailers are taking big bets on these platforms, and so they're trying to monetize them fairly quickly. My advice would be maybe to, maybe start on a softer foot and really earn trust of clients first.
Yeah, and a lot of the CPG earnings are efficiency and cost effectiveness are are big keywords that we're hearing over and over again from those players. Anything else on sort of ads specifically within revenue? I know there are a few others as well. And ads and tariffs together, right? I think we've heard some retailers be more sanguine about the impacts they're going to see on their business. And then you had Etsy talking about how these tariffs were really going to impact a lot of their sellers that import directly and sell to U.S. consumers. So, Nidhi, what are we hearing from some of the other retailers in the ad space?
Yeah, I think, as kind of marketers themselves, that growth is kind of mixed. You've got some of the European players, showing low single-digit growth in how much they're willing to spend in marketing. Etsy themselves as well, like the kind of growth in marketing spend has been about 15%. But when you look into how much of that is going towards performance, a lot of it is going towards that rather than kind of brand. So there's differences in strategies amongst the players. I think what's also interesting is a lot of mention about AI and the kind of agentic AI, which we've discussed a lot through this year, next year, and in our previous podcast as well. And I think I just want to call out one interesting kind of mention about the agentic AI, and particularly Zalando saying it not having a material impact on traffic coming from large language models yet, but it's not very meaningful, which is something we've been hearing a lot about this Q2 earnings, not just from retailers, but also other categories, which is interesting.
Yeah. And Jeff, you looked at Shopify, right? Also in this space with a, U.S. America's sort of hat on. Is that tallying with everything you heard as well?
Yeah, it was a very interesting earnings from them. They, I guess, I have to check the stock price, but they're, I believe, the largest company in Canada now by market capitalization. After their earnings, the stock was up over 20%. So the top line growth of revenue growth of 31% to $2.7 billion. They singled out Europe being a strength, that Europe was outpacing growth in North America and Asia Pacific. And the president did say in an interview later after the earnings that they're still growing across all their regions. They so far see no slowdown from the tariffs. So I thought that was an interesting thing to kind of point out, with all the tariff chatter going on.
Aisha, do you have clients on Shopify or any view on that platform compared to others? Because it's a little bit of a different model. We sort of, I think in the past, held them out from our retail media, but as they're talking about marketing being a bigger sort of portion of things, how we designate them within now that we're broadening it to wider commerce, I think makes sense.
Yeah, no, I think it's what's interesting is I think Shopify is actually benefiting from the tariffs in the sense of we've seen some of our enterprise clients, which once were, Magento or some of these larger enterprise platforms all the way, now actually being open to Shopify, given some more of their sophistication. They've leaned in really heavy with AI, and their tooling for clients. So I think it's really interesting to see more of these larger players who once thought they outgrew quote unquote Shopify actually come back to Shopify. And then on top of that, Shopify retaining its SMB and mid-market space. So, kudos to Shopify. I think they're doing really well. I'm really bullish on their strategy.
That's really interesting.
Oh, as you say, that's a great point because they did bring that up on the earnings call, how they are seeing a lot of business with larger established brands and not necessarily the mom and pop and small and medium-sized enterprises.
Which I think is the connotation or the sort of thought I have had about Shopify from the early years. So it's good for folks to understand that may not be the whole truth going forward now.
Exactly.
All right. Any other closing thoughts on the week? I know we haven't gotten to everything as well. We didn't quite touch on Snap. Obviously, they're underperforming a bit at 9% growth versus their sort of digital peers from last week. And so we may get into more of that next week as well, but definitely looking at that as interesting counterpoint to some of the growth we've seen elsewhere. So just how consolidated is that growth within the advertising market, not just between the more digitally focused players and say TV, but also even within digital, the extent to which these companies are investing in AI, but also growth in marketing. And Snap tends to lag behind its peers in terms of its advertising investment on the buy side. So maybe that has an impact as well. Any other closing thoughts for the week?
No, just looking forward to, getting caught up on earnings and like you said, catching our breath and just kind of digesting all of this. It's been a lot to take in over the last few days, especially there's been a lot of out of home earnings. I think there's some really good information in there as well. So we'll have a time to go through that a bit more in detail.
Yeah, I think it's now towards the end of the week and we just had the UK interest rate decision today as well with a rate cut. So lots of economic news and alongside earnings that's keeping us busy and probably will do next week as well.
All right. Well, out of home ties in with commerce as well. So maybe we'll have to get the Aisha's perspective at some point on that down the line too. All right. Thank you, Aisha, for joining us this week. Special guest. And thanks always to Jeff and Nidhi. We will catch up with everyone again next week. As a reminder, the WPP Media Intelligence podcast is meant for informational and entertainment purposes only and should not be taken as financial advice. We'll see you next week.